All right. Well, good morning, everyone, and appreciate you joining us for another Morgantown Area Partnership Virtual Learning Lab. I'm Russ Rogerson. I'm the president and CEO of the organization, and one of the many things that we've been trying to do during this whole pandemic is to bring information to our membership that is pertinent to the day and the time. And we've had a series of these that are on our website, morgantownareapartnership.com. And we're really pleased to have this one today with Suttle Stalnaker on best practices for year-end compliance. As we all know and talk about how unique this year has been. So I think it's only most important that all these factors come into your thought process in your normal year-end closing. And what a great company we have in Suttle Stalnaker to kind of cover some of these issues, and if not answer your questions, give you reason to think and to follow up and to find out more about your business. So we're pleased today to have Ryan Mink and Nicole Beal from Suttle Stalnaker, and they're going to be your presenters today. But before I turn it over to them, I also want to remind you that we are recording this because we will place this presentation on in our library, so that if you want to share that with other people that you think would benefit, please do. And then for question and answers, we ask that you use the chat, and we'll address those questions at the end of the formal presentation. So with that, I'll turn it over to Ryan, who will get us started and provide us with some very good information. Ryan?
Thanks, Russ. Yeah, so we were going to cover some best practices, HR, compliance-related things, and then we'll touch right at the end on some tax planning items as we head into the end of the year. I'll go ahead and give my caveat. I have 5 kids in the house doing remote learning, so there is a chance that somebody will knock on the door. And I also have big, heavy trucks driving by for some reason. And there's a new puppy in the house, and so there may be some barking at some point. So I'll just throw that out there. I'm hoping none of those things happen, but there's a chance that they will. So again, I'm Ryan Mink. I'm a senior manager with Suttle Stalnaker in our Morgantown office. I'm going to cover the first little section here, and then I'll transition it over to Nicole to cover 2 or 3 sections, and I'll let her introduce herself at that time when she jumps in on Affordable Care Act items. And then I'll kind of wrap things up with some tax planning. So the first thing we want to just let you know is about us. So we have 3 offices, Morgantown, West Virginia, Charleston, West Virginia, and Parkersburg. We have about 80 staff people in our office. We do tax, audit. We have a client accounting group that does bookkeeping and payroll. And we also do some HR consulting, which is kind of where this came into play, because we took a look at what we advise a lot of our clients to do with our HR consulting practice. And so that's probably a good thing to cover as a reminder for everyone of things that they need to be looking to do as we wrap up the year and head into the new year. So it's things we do internally, but it's things we also advise our clients to do as we work with them through open enrollment and getting things ready for the new year. So like I mentioned, we do have small business and payroll services. We do human resources consulting. Adrima Foster's our HR director should be joining us a little bit later to help out with some of the Q&A if there are specific human resources questions. And she's the one that kind of spearheads that consulting group for us. And of course, we do tax preparation for businesses and individuals. And we also help with payroll protection program loans. So if you're struggling on trying to figure out, should I apply for forgiveness or should I not? Or the bank's asking me for all this information and I'm not sure what they're asking for or how to calculate it, please feel free to give us a call and reach out. We'd love to talk to you about it, see if there's a way we can help answer questions. We helped our clients get over 250 loans. And we've worked with most of the banks, if not all of them, in West Virginia. We have a really good relationship with them. So we should be able to help clarify some things and help walk you through that process. So with that, let's jump into kind of the first section here, which is general HR items. So the first item on the list is going to be taking a look at your employee records and your I-9 files. You want to peruse through them. Hopefully you don't have hundreds of employees, so it might take a while, but if you have a handful of employees, if you have a number of employees, maybe this is a process you start heading into the new year to make sure everybody has all of their information in their files. You've got a copy of their driver's license, social security card if you need it. They filled out an I-9 and you have that on record should somebody come knocking and asking for it. And then you definitely want to make sure that your information for your employees is up to date. So we always, for our firm, we get an email towards the end of the year asking us to, can you confirm your your home address? Can you confirm your emergency contact? Can you confirm your cell phone number or your home number that you'd like to be reached at? Just to make sure as we head into the new year that we know how to reach everybody. We know who to reach in case of emergency, and all that stuff is updated. The other thing to keep in mind is if you have outdated or old termination documents or job applications that you haven't done anything with, or you've had employees that have left a long time ago and it's time to start shredding some of that stuff, it's a good time to kind of clean up right as you head into the new year. And then make sure that your I-9 binders are following the U.S. Citizenship and Immigration Services guidelines. And if you have questions about what those may be, feel free to reach out to us. The end of the year is also a good time to update your employee handbook and to distribute a calendar for 2021. We also do this at the end of each year. We take probably a month and a half heading into the new year and start as a management team discussing, what do we want to change as we head into 2021? Are there any new policies we want to implement? Are there any changes to any of our benefits that we want to implement? Are there COVID related items that we need to address either now or as we head into 2021? And it never fails. We always have some little tweak or change, whether it's a new benefit or a change in a benefit or a change in a procedure. For example, telecommuting is a big one that probably a lot of people are working through and dealing with. And if that's something that you found your employees have done well with and may be a potential benefit or option for them going forward because you found that it works really well, this would be a really good time to talk through what do we want that policy to look like so that maybe we can implement it maybe post-COVID. That's kind of how ours is working. Well, right now we have our COVID policies where some people are in and some people are out. But as the vaccine takes place and as we kind of move back into normalcy, hopefully at the tail end of next year, if that's something we want to offer to our employees because we found that it works really well and we've got the technology infrastructure in place, it's probably a good time to start talking through what does that policy need to look like. So there are a few things in that paragraph that I've already addressed, but definitely making sure you're current on any employment law requirements in your handbook. As I mentioned, COVID related items. If you want to add something about telecommuting, privacy, because also that's a big deal. If you have people working from home and they have sensitive data, there needs to be an understanding of the privacy requirements. Any changes in compensation or performance reviews, social media or IT usage is a big one. Again, things are different with people at home. So this may be something you want to address, especially if they have a work computer or work infrastructure at the house. And then, of course, if there's any changes you want to make to time off or holidays or anything like that, now's a good time to do it as you head into 2021. And then if you have a calendar that you maintain for your business, it's also a good time to distribute to employees. They know, here's the breakdown of the vacation you have based on your years of service. Here's our anticipated state, federal holidays that we're going to observe. And then, various pay dates they should expect as they go through the year. Next item is going to be compliance. So there's always required compliance documents that have to be distributed at the end of the year. And this first paragraph kind of summarizes some of them. So you have HIPAA related items, privacy items, you have CHIPRA, so Children's Health Insurance Program Reauthorization Act. You also have COBRA, women's health and cancer rights. And then also if you offer a 401k plan, there may be required disclosures related to your 401k plan that have to go out each year, such as your summary annual report, or if you have a safe harbor provision, you may have to issue that safe harbor notice at the end of the year. So make sure you're aware, or at least to maybe ask the questions, and that may be one you follow up on. Hey, what do you guys send out? And reach out to us, and we'll let you know kind of what we send out. And that may spur something in your mind to go, I've never done that, or oh, that's right, I need to do that at the end of the year. And you want to make sure you get those out before the year wraps up. The next item would be your FTE, so full-time equivalents. You do want to make sure you have a good handle on, and this uses the word audit your FTEs to make sure you know how many full-time people you have working at your company throughout the year. So for each payroll period, because some of these requirements require like a 20-week period for a threshold for whether or not you have to comply. Some of them are annual. So you do want to make sure you have a good handle on what is your FTEs for the year to see, do you now fall under the requirements for the Family Medical Leave Act, which again has specific notices and specific requirements you have to start addressing. And then you also have the Family First Coronavirus Response Act, which also comes into play because of COVID-19. And those requirements are going to be a little different. So you do want to make sure you have a good handle on FMLA and the FFCRA and the related requirements and notices for employees as you head into the new year. The other thing to look at is your employment applications. So if you have a standard new hire employee application, this one is a unique one. And truthfully, I had to Google it yesterday to figure out what is ban the box. But what it is so you are, in some states and municipalities, you are not allowed to ask if you've been convicted of a crime on your application. So it may be worth looking at your application to see, A, do I have this question? And B, where I'm hiring employees from, is there a requirement that I can't have this on my list? So West Virginia does not have a ban the box law. So if you're just within West Virginia, you're probably okay. If you hire outside in other states or in other municipalities, because it can be city specific, you do want to make sure that you're complying with that rule in all the locations you may have or be hiring employees. And again, in today's world where we're doing stuff virtually and remotely, there's a chance you may be looking to hire people throughout the United States. And so then you run into those issues. The other thing to look at is any required compliance training. So you definitely want to check on federal, state, industry specific training that may need to happen before the end of the year. Maybe an annual training that needs to happen in the year end, maybe a good time to do it. As well as anything internally you guys want to tackle before you end. West Virginia doesn't have COVID specific training requirements, but you should consider if the OSHA or CDC have their own recommendations that may be worth checking into or following related to COVID-19 protocol. And then check OSHA policies. So they revise their stuff and update their stuff periodically, and you want to make sure you're staying in compliance with OSHA rules, especially related to COVID-19. Some of those things may include increasing your in-person inspections and your record keeping related to COVID cases. So new for 2020, you want to make sure you're reviewing your overtime pay for non-exempt employees with fluctuating work weeks. So these are non-exempt employees that may be paid a salary, but their schedule fluctuates. They may work 45 hours one week, they may work 38 hours another week, they may work 50 hours a third week. And so they're paid a base salary, but their work, it's not always an even 40, it fluctuates. And when that happens, this rule can kick into place, which is you may be required to pay overtime, and the calculation's a little unique. You may be able to pay, maybe be required to pay overtime to these people. And so you want to make sure you're doing that and you're doing it appropriately. Again, this is one that's going to be nuanced. So if you're like, you know what, I kind of have some of those people, Ryan, that we do have people that are fluctuating in their time and we do pay them salary and they are non-exempt employees. If you want to reach out and ask us and let us know kind of your situation, we'll help you walk through that calculation and see how we can clarify the rules for you. And then equal employment opportunity data collection deadline was extended. So due to the pandemic, it was pushed back till March of 2021. And the EEO1 requires that covered employers submit information such as the number of employees sorted by job category, race, ethnicity, and gender. You need to submit that information. But again, that deadline has been extended until March of 2021. So I'm going to turn it over to Nicole. She's going to cover some ACA items and as well as some other payroll related items. And then, like I mentioned, we'll wrap up with some tax planning issues.
Good morning. I'm Nicole Beal. I am a supervisor with Suttle Stalnaker. I work out of their Parkersburg office, but I've actually been remote for the last about 5 years. So working from home is not new for me. So I'm going to be talking about some compliance for the Affordable Care Act and some payroll items. The Affordable Care Act is not new, so many of you may kind of already understand a little bit what your compliance rules are regarding it. But Ryan talked about the full-time employee or full-time equivalents earlier and how you should look at those and determine how many you have. So if you have more than 50 full-time equivalents, then you are required to file Form 1095-C to your employees and 1094-C to the IRS. So what this form essentially does is it lets the employees and the IRS know, one, if you had a healthcare plan that met minimum essential coverage, and if your employees opted into the plan, if they opted out of the plan, and how many months they were covered. So those are some things that help the IRS track if employers are compliant. And these forms are due by March 2nd to the employees and to the IRS on February 28th if you're filing on paper, and the 31st if you are filing electronically. Historically, these deadlines have been pushed back, but we haven't received word yet on exactly if they're going to be this year, so just plan on getting them in by the due date that's there. You'll also want to review all of your payroll information regarding, or not necessarily your payroll information, but certainly who those full-time equivalents are. The reporting must include the entire 2020 year. So even if they worked just a couple hours at the beginning of the year, you didn't even really have time to process payroll forms at that point, you still have to report them. And they'll be included on that 1095 package. So the slide shows a listing of those that should be included on your form. So even beyond employees, people who may have retired, but your company is still paying on benefits, owners, directors, partners, anyone enrolled in your plans, employees that left that are enrolled in your COBRA coverage, dependent information, and Social Security numbers also need to be on there. You can go ahead to the next slide there. There are penalties associated with non-compliance. If your company fails to offer health insurance that meets the minimum essential coverage requirements, you could owe $2,570 per employee. It excludes the first 30 employees. So fortunately, there's a little bit of a break there, but you'll still want to make sure that you're in compliance. If an employee receives a subsidy on the exchange, and it is also determined that you did not meet the requirement for minimum essential coverage, the penalty actually increases to $3,860. And if you fail to file the necessary forms, then it's $550 per employee. So that's similar to the W-2 non-filing penalty. So it's important that you prepare these forms. I completely understand that they are challenging to fill out. Some of the wording, every year I have to go back to make sure that I understand what each of the little codes mean. But once you kind of have a system in place, then filling out the forms, especially if you have a template, then it makes it a lot easier. If you have any questions regarding that, please contact me or someone else at Suttle and Stalnaker, and we can walk you through that process as well.
Yeah, because I would mention this is one area that we do prepare these 1095s internally. So if you've now broken that threshold and you now have to do these and you need somebody to help you prepare them, we can do that. Or if you haven't been getting, what you feel like is good service or timely service, we'd be more than happy to talk to you about trying to get these out the door for you so you can get them filed and avoid those penalties.
So you also want to review your year-end benefits, review your insurance policies, especially with employees working from home. There's additional risk exposure potentially. You'll want to talk to your general liability insurance provider. Also check with your workers' compensation broker to see if those policies need to be changed as well. Your premium might change a little bit, but you'll definitely at least know that you're covered in case of additional exposure. You'll also want to review your healthcare filing requirements and deadlines and make sure that everything has been met. The healthcare exchange began an open enrollment period on November 1st, and that actually goes until December 15th, which is just next week. So if you haven't looked into that yet, please look into that and make sure that your company is in compliance there. Review your next year healthcare plans and compare that against the affordability thresholds. Last year they were 9.78%, and this year they are 9.83%. So they did increase a little bit. There are some changes to health savings accounts in 2021. The limits on high deductible healthcare plans remain the same as 2020. So it's $1,400 for self only and $2,800 for family coverage. the limitation on combined contributions did increase a little bit by about $50 to $3,600 for self-only and $7,200 for family coverage. The annual catch-up contribution for 55 and older remains the same at $1,000. The annual limitations for flexible spending accounts have not been announced, but it's expected that they will remain the same at $2,750 per year. The allowable rollover for flexible spending accounts is $550, and FSAs are use it or lose it. So if you have not gone through your FSAs this year and you still have some funds remaining and more than the $550 rollover limit, go see a doctor, take your kids to the doctor, and use those deductible contributions that you have already had taken out of your check, because you don't want to lose those.
Yeah, we'll take a moment to say the health savings account is a good tax savings tool. So if you do have or are able to participate in the high deductible health plan, this is a good option to put away money tax free. It's not use it or lose it. So it stays in an account and you can use it for medical expenses. And if you don't utilize it, it just continues to roll over and grow until you may need it in a future year. So it's slightly different than an FSA, which Nicole mentioned is use it or lose it. In an HSA, it goes into essentially a pool or a pot of money for you, and it just stays there until you need it. And so it can keep growing and keep growing year over year over year until you retire, essentially. So if you're able to access high deductible health plan, that's probably something I would recommend looking into as a tax saving strategy is, can I make an HSA contribution? Especially if you know you're going to end up paying medical expenses anyway as you head into the next year. The money will go in there tax deferred, and then you will be able to access it later.
Thank you for that. You will also want to review your FFCRA. Ryan had mentioned this a little bit earlier. This is the Family First Coronavirus Relief Act, and make sure that you are in compliance with the new Department of Labor guidelines. They have some additional guidance that was effective September 16th that include clarifying the requirements that for documentation supporting the need for the leave, and a listing of revisions can be found at the Department of Labor's website. So you'll want to review these regulations, ensure you're in compliance. Part of that compliance is making sure you have a poster on some sort of location that all of your employees have access to and can see. You'll want to make sure that your group health plan is in compliance, because the FFCRA requires the plan to cover COVID-19 testing, diagnostic testing. So again, make sure that your plan covers that as well. You'll also want to review your employee benefits package to ensure that it continues to align with the needs of your employees. So if your employees, if most of them are working from home, and if it's expecting that they're going to be working from home, make sure that your benefits are aligning more with those needs, as opposed to potentially outdated items that aren't really being used, because that's spending money that you could be saving and not helping your employees much. So it benefits both the company and the employees to make sure you're giving the employees the benefits that are actually useful in terms of changing your work environment. Payroll tax items. This is a little bit where I'm a little bit more comfortable. You may have noticed I was a little bit nervous talking about the Affordable Care Act and those other benefits. I don't work with those a whole lot, but payroll tax I work with very regularly. So at the end of the year, just like with every quarter, you want to make sure you file your 941s. Year end requires also your 940s, your federal unemployment taxes as well. Those forms are due January 31st. If you have already made all of your FUTA deposits, your federal unemployment deposits, then you actually have until February 10th to file. So that's a nice little grace period. Typically, you're required to start making deposits on your federal unemployment once you reach $250. But if you haven't reached that threshold yet, you want to turn it in just when you file your return on January 31st, that's fine too. But you get an extra few days there if you've already made all your deposits. For the non-employee compensation, so your forms 1099, which is what you are typically used to filing, your miscellaneous forms, those are actually going to be filed on non-employee compensation forms this year. So I'll talk a little bit more in detail about that on the next slide, but just make sure that you understand that there's going to be a little bit of a difference with your 1099 forms this year. Copies are due to the Social Security Administration by January 31st and to the IRS on February 28th if you're filing on paper, and then March 31st if you're filing electronically. So if you can file electronically, it's nice to have that little bit of a grace period there. So your forms 1096 and 1099 generally look the same this year. Like I said before, your non-employee compensation is going to be filed on a new 1099 NEC form. So this is separate from the 1099 miscellaneous that you are typically used to seeing. So if you paid freelancers, independent contractors, your accountants, anything that's just a typical service fee that normally would have been filed in box 7 of your 1099 miscellaneous is now going to be filed on your 1099 NEC. All different types of 1099s have to have their own separate 1096 cover sheet. So it's very possible that you will have a stack of maybe 20 1099 NECs and then one 1099 miscellaneous for your rent. And a 1098 for interest. So you might have several different types of 1099 forms to submit to the IRS. Each of those different types need its own 1096 cover sheet. So it's similar to, your W-2s, they have a W-3 that's a cover sheet. It just lets the IRS know, okay, which stack of documents am I looking at now? If there are any changes or updates to be made for your payroll for the new year, please contact your payroll provider, your bookkeeper, whoever is in charge of handling that. So that way they can update benefits, they can update any bonus programs, and make sure that any deductions that are going to be taken out on the first payroll of the year start at the first payroll of the year. So that way there aren't continuing problems that you're trying to catch up with. There are some differences in your 941 forms that I'm sure that many of you have observed over the last few quarters as you've been filling them out. So for the FFCRA, there are a couple tax credits available. There's a couple deferrals available. So one of the things that is available is a dollar for dollar reimbursement through your 941 for paid leave to employees or potentially their dependents, their spouse, their families that meet certain rules. Generally, those rules include if an employee tested positive and stays home, or if a family member tested positive and the employee stays home. Those are typical, just basic. There are certainly some more rules than that, but I'm not going to get into that level of detail here. But both of these types, the employee and the family leave, the emergency paid leave, are set to expire at the end of this year. So be aware of that. As of right now, that has not been extended. There are record keeping requirements. You'll need to take notes on, obviously, which employee was affected, what dates they tested positive, what dates they were out, that sort of thing. So just keep in mind that there are some additional administration requirements there. If you have fewer than 50 employees, then you may not have to be able to, you may not have to do those extra bookkeeping requirements or extra record keeping requirements. There we go. And each employee must be able to see that FFCRA notice that I mentioned earlier. It must be in a place that everyone has access to and everyone can see. So to calculate your CARES employee retention credit, it is equal to 50% of the qualified wages paid to employees. This is the time period after March 12th. That's when when the government declared the pandemic. That's kind of when people started shutting down, people started getting worried. So that was the beginning part of it. So from there until January 1st, and before January 1st, so through December 31st, it can be 50% of those wages up to a maximum credit of $5,000 per employee. And that is actually taken against the employer portion of the Social Security tax that goes on your 941. So you'll see different lines that you can take your credit on the 941. And it is per employee. So there's, in addition to the 941, there are some worksheets that you can fill out that are provided on the IRS website that you can determine by employee how much you owe. But the total amount goes on the 941. You do not need to send in the worksheets or the detail with your 941. If you received a PPP loan, you are not eligible for this credit. And I'm going to back up just a little bit because I don't think I clearly explained this credit very well. This is a credit if you kept employees on staff and during the pandemic, and you tried not to fire them, I guess is what it comes down to. So if you did not get the PPP loan and you kept employees on staff, that is what allows you to potentially be able to take this credit. If you have more than 100 workers, then you can claim the payroll tax credit for those who've been furloughed or their hours reduced due to the shutdown or other, hourly backslides due to the pandemic. If you have fewer than 100 workers or 100 and fewer, it doesn't matter if they've been furloughed or reduced hours or any, it applies to everybody. So more than 100 hours or 100 employees, it applies to just those that have had reduced hours or have been furloughed but are still on staff, and fewer than 100 workers, then it doesn't matter if their hours have been cut or not. You want to check your IRS guidance on the payroll tax deferral as well. This is actually one that many clients have taken advantage of over the last few quarters. So what happens here is an employer, the 6.2% of the Social Security tax, that is the employer portion, that can be deferred in payment over the next 2 years, potentially saving current cash of thousands of dollars until your business can kind of get up and running again. But again, it is a deferral. It's not a tax credit. It's not a tax break. It's not forgiven. It's just you're able to kind of defer this portion of the payroll tax that is typically due by the end of the quarter, but you have until December 31st, 2022 to be able to pay that. So just make sure that if you are choosing to defer, that you have a plan in place to repay it back over the next couple of years, because you don't want to get to December 2022 and have a $200,000 tax bill because you have 150 employees and you've been deferring the Social Security tax the entire year. So just be aware that you need to have a plan in place as well. The Payroll Tax Holiday was an executive order that occurred in September, and it can go through September 1st through December 31st. It applies only to employees that have wages of less than $4,000 for a biweekly pay period. That includes salary workers earning less than $1,004 per year. So there was a lot of question regarding this, and it, in similar terms to the employer portion where it's deferred, the employees can defer their Social Security as well. They can opt in to do that. But again, it's not a credit. It's not something that is just free money. They will need to pay it back. So from the employee perspective, they need to have a plan in place of, okay, so I'm saving this much per paycheck. Let me make a plan so I can make sure I have it paid back by the period that it's due. So your PPP loans, many of you probably have already received them. The loan forgiveness can be excluded from gross income. However, the expenses that were paid for by use of this loan are then not deductible on your tax return. So just be aware it's kind of an offset. You're not recording the income, but you also don't get to take the deductions against it. So consider that as you are doing your tax planning and making estimated tax payments for 2021 and your last quarter of 2020.
Awesome. Thanks, Nicole. So we have a couple minutes left. I'm going to talk through some tax planning items. I'm going to reiterate at least the one that Nicole just touched on, which is the PPP loan. And then we'll open it up for some questions if there are any. So just some quick notes. There is the ability currently to claim some quick refunds related to disaster losses. So nearly every U.S. business is eligible for disaster-related refunds from losses incurred in 2020 on a 2019 return for a quicker refund. Also note that currently 179 deduction is up to $1 million. You can take as 179 deduction. It needs to be for assets placed in service beginning in 2020. It does phase out as you go from 1 million to 2.59 million. But keep in mind, currently bonus depreciation is at 100%. So you can get the same impact by taking bonus depreciation as you could as taking 179. Bonus depreciation is eligible on used equipment too. It has to be new to the taxpayer, but it can be used. So there are some other opportunities there without having to deal with the 179 items. Quick note is that the idle grant expenses appear to be deductible at this point, but it also is understood that idle grant funds are going to be taxable income. So if you got an idle grant that's going to be picked up as income, but you will be able to deduct those expenses, which is a little bit slightly different than the PPP loan. Another item is NOLs. If you have net operating losses that have been carrying over or you incur one, they can be carried back up to 5 years. So that, again, that's a quick opportunity to get some cash back in your pocket. If you had a prior year that had income, but whether it's 2020 or maybe last year, 2019, you had some losses, you have the ability to carry back those losses and offset some of that income in prior years to get refunds of those taxes that you paid. So that's a huge opportunity. We've done that for a number of clients already where the last year, 2019 or 2020, we know they're going to have some losses. And so there's an option here that we want to go ahead and reach back and kind of address some of those things because the rule had changed where you can only carry them forward. So we want to make sure we take advantage of that for sure. And as Nicole mentioned, the PPP loan, so the current update on the PPP loan is, yes, you don't pick it up in income if you get forgiveness. And yes, currently Treasury says that, well, you also can't deduct those expenses, which is not the way Congress intended them to interpret the law. So there are numerous professional organizations, one of them being the AICPA, but there are numerous other business associations encouraging Congress to specify in like the next relief package or whatever it may be that, no, we intended the income to be not income, so the forgiveness to not be income, and we intended the taxpayers to be able to deduct the expenses. So Congress intended for us to be able to double dip. The IRS and Treasury said, no, that's not the case. So the current update is, no, you can't deduct those expenses right now, but there is language in some of the laws that are in work right now, especially some of the next relief packages that clarify their original intent. So if those can get passed, it may end up happening that we can deduct expenses and not pick up the income. But as of right now, it's not the case. So make sure you're watching your news feed. Make sure you're checking the alerts you get, whether you subscribe to our newsletter or your own accountants or you're just reading the news. Keep your eye on that because that may change in the near future. Also, they changed the AMT under the CARES Act. So especially for corporations, you can claim all remaining credits that were outstanding in 2018 and 2019 to get you some quick refunds. We talked about current losses for quick refunds just a second ago. And then for bonus depreciation, they also did change the rule for qualified improvement property. So if you have qualified improvement property, and that may be something you coordinate with your CPA or accountant on and say, do we qualify for this? They changed the rules on that to where there now is an ability you can go back because they changed the definition. You can go back and recoup, again, those expenses. So take, let's say 100% depreciation or bonus depreciation on those, recoup those expenses and create a refund in a prior year. So definitely worth something looking at. And then for payroll deductions, again, Nicole touched on deferring your Social Security taxes. You definitely want to take a look at when the best time is to repay those funds. So 50% is due in 2021 with the remaining 50% due in 2022. But it may make more sense for you to go ahead and pay those and take the loss earlier. So definitely discuss that with your CPA or reach out to us if you have any questions. And I do want to touch on quickly, I don't want to get political, but I do want to touch on quickly, the potential impacts of the election results. So the biggest thing right now is the Georgia Senate race. Depending on how that falls out, whether the Republicans win both seats or the Democrats win both seats, or it's a 50-50 split, will have a major impact on potential tax changes next year. If the Democrats were to win out in both seats, I would anticipate that there will be significant tax changes next year, with potentially rates going up and some of the stuff that was created in the Trump administration being rolled back. If the Republicans were to win one or both seats, I would imagine that tax changes will not come very quickly at all, because it'll be really tough to get anything through the Senate. With that said, you may want to take a look at what do I think is going to happen, and then work with your accountant or CPA to go, okay, I think this is what's going to happen. And if that's going to happen, I think tax law is not going to change, or I think there may be some tax law. What do we need to do to plan for this thing that I think is going to occur? I think tax rates are going to go up. So what should I do, Mr. or Mrs. CPA, to make sure that I save expenses for a future year, or I go ahead and push expenses into this year? So there's definitely, it makes it really tough on CPAs to help you with planning, because we just don't know, right? So that election happens in early January, and then it may take a while for them to certify results. So we just don't know where it's going to land. So it makes planning at the end of the year tough, but keep your eyes on that as well, because depending on which way that goes, it may impact tax law changes that you may see in 2021. And so with that, we are done, and we will open it up to any questions. And we did have, looks like Dreama did join us. So if you have any specific HR related questions to some of the items that we talked about during the presentation, she should be able to chime in to help with that. If you have any tax planning questions too, we can address those as well.
So I think this information you provided has everybody thinking, Ryan and Nicole. It's quite amazing when you take this year and all the changes associated with it, and how that trickles down to us as individuals and as businesses. And so really appreciate this overview, and certainly encourage all of our members and those in attendance today to follow up. This is a challenge that people are trying to keep up with, and you certainly want to be able to take advantage of those opportunities, but also avoid some of the pitfalls. And this has been very helpful. All right, we do have one question pop up. Oh, just a thank you. So I guess if there's no more questions going to pop up, we'll wrap this up. And again, thank you both for what a very good presentation. And we look forward to keeping up to speed and communicating out to our membership as these changes continue. So thank you again, and please don't hesitate to follow up. Here's the contact information for Ryan and Nicole with any questions that you have offline. So that wraps up today's virtual learning lab, and you'll see it posted here on our website here and probably the next day. So for sharing with others. So thanks again, Ryan and Nicole, and appreciate your time and effort, and certainly appreciate all that you do for our communities. So
sure thing. Thanks.
Thank you for having us.